Now let's look at the other crucial elements of accounting, which is capital. Capital is further divided into three sections: equity, income, and expense. Income is also called as revenue. Expense is also called as cost. Let's start with equity. Let me explain this with an example. To start a business, we need capital, right? Capital in simple terms means money. A person who invests in a business will become a shareholder and owns a part of that company. Equity is nothing but the money that has been invested by a shareholder. Okay. And there could be many shareholders for a company. Capital can be invested in the company at any point in time. For example, people invest capital at the initial startup phase of the company, but also shareholders can invest money during any period of the business operations. And also when the company gets listed in the stock market and issues its shares. The first time when a company issues a share after getting listed on a stock exchange is called IPO, initial public offering. And also company can get capital when it is being publicly traded on open market after the IPO. So company can get money in many different forms. So always remember this. Equity is the amount of capital invested by a shareholder. In business accounting, in financial accounting, this equity plays a big role. So please do remember this. It is very important. Okay. Now I'm going to put up an important question. In the assets section, we discussed cash is considered as an asset. And right now, what we're saying is when a shareholder invests money in the company, it is called as an equity. Why do we not call it as an asset? Not to worry, if you're not sure, I will explain it and it becomes very clear. You will get the distinction between equity and assets. This is why it is really important to understand the concepts. There are two words here, right? One is equity, one is assets. Equity is just a book value of the shareholder's capital, meaning it is recorded in the books stating that X amount of money is invested by so and so shareholder so that the company can keep track of the shareholder's capital. Since companies have to keep track of the shareholder's capital, it is recorded as an equity. Okay. Whereas the money which a company has received from the shareholder is considered as an asset because that is something a shareholder has given to the company for the company to use it. Because company owns this money, it calls it as an asset. From the company's perspective, it is an asset. From the shareholder's perspective, it is an equity. Okay. So if anybody is investing money in a company in the form of capital, then an entry is written into the book saying that an equity of X amount for so and so shareholder. And the cash is recorded in the books as an asset. I will explain how the entries are done and it will be clear when I talk about the double entry system under accounting process in the video itself. So stay tuned. Okay. This is very important. I just want to clear the distinctions. So now let us get a bit more into the details and understand the relationship between the assets, the liabilities, and equity. Let me explain that relationship. Okay, you will get to know the formula, how these three things are linked together with a very good example. Okay, let us say a person is starting a company called ABC. Okay, and if that person has invested some capital in the business, we call this person a shareholder, as we know. At the very start of the business, no one has invested anything. We're just starting up the business. We need capital. Some person has come up giving some money to the company, and that is all the money that the company has. So at that point in time, the asset of the company is the cash, and it is equal to the equity of the shareholder. So now the equation should look something like asset is equal to equity. Whatever has been invested by the owner is the only asset that a company has, right? Now let us say after some time, after a year, when the company starts running the business, it may take some loan from a bank. When a loan is taken from a bank, This loan is called a liability because the company is obliged to pay the money that it has taken from the bank. But the cash that we receive from the loan, what is it called? It is called an asset. So now the loan becomes a liability and the cash becomes an asset. If you observe carefully, so we have cash from the shareholder before, now we have cash from the loan. Now our assets of the company have gone up because we have more cash that was given to us by the shareholder and that was given to us by a bank. At the same time, we also have added a liability. The liability has gone up. Before the equation was when the company got started, asset was equal to the equity. Now, after taking a bank loan, total asset that we have is equal to the equity that we receive from the shareholder and the cash that we receive from the bank. So we have an equation now. Asset is equal to the equity plus liability. Just get this concept right, okay? Now, imagine if the company has returned the money to the bank. In that case, our liability has gone down. So is the asset as well, because how are we paying the money to the bank? We're taking the cash that was with the company and paying it to the bank. So the asset has reduced, but also at the same time, the liability has reduced. And still, the equation will remain intact because assets is equal to equity plus liability. Let's assume there is no liability at all for the company, and we would consider liability as zero. Okay, even if you take the same equation, asset is equal to equity plus liability. If there are no liabilities for the company, we put zero in the place of liability. That becomes asset is equal to equity. The moment we have some sort of liabilities coming in, our asset will grow up and liabilities get added to the equity. Just get this concept right. Okay. When you take a loan, cash is coming in, it is increasing the asset value, and also at the same time, it is also increasing the liability. Okay. You may also think, why is equity not being considered as a liability? Why is it being specifically mentioned as equity and not a liability? Because at the end of the day, we have received money from a shareholder, right? Yes, the distinction is, this is what you need to understand. The reason is, even if the company is making losses, company is liable or have an obligation to pay back the loan, but there is no such obligation to return the money to the shareholder. So if company makes profits, shareholder will get more money, but if company makes losses, shareholder will lose money. Shareholders will only be benefited if the company makes profit. Okay, if there are more shareholders, the profit is distributed according to the equity that they hold in the company in the form of dividends. Dividends are nothing but the portion of money that is set aside from the profits to distribute among its shareholders as a gesture for the capital they have invested. Equity comes with a risk. Okay, the shareholder is ready to take the risk. But whereas when you take loans or when you borrow money, you have an obligation to pay back. So they are less risky than equity. Okay, let's suppose a company is being sold due to its non-performance. The first thing that gets cleared is the liabilities. After that, if there is anything left, then it will be distributed to the shareholders according to the equity they hold. Let's assume if the company was left with nothing after it has been sold, then the equity has become zero. Okay, so that is the reason we give a separate name for equity and we give a separate name for liability. We now have come to a logical conclusion how we have gotten this formula asset is equal to equity plus liability, right? Now you can use the same formula and then you can also calculate the equity. Now if I take liabilities from here and send it to there, then the equity is equal to asset minus liability. Okay, this is a universal formula for any business. Never ever forget this equation. Yes, I mean it. It is such an important equation that the whole world's businesses run on it. Okay. So the more the asset and less the liabilities, it is good for the shareholder. Okay. Now let's understand various types of equities. We have something called paid in capital, retained earnings, and net profit. Let's start with paid in capital. It is nothing but the firm's starting capital. For example, if a company is getting started, if shareholder A comes in and invests the money, it is called paid in capital. Okay. And what are retained earnings? These are the dividends that were not distributed to the shareholders in the past years. Let's assume a company is making profits and it is making profit year on year. It is upon the company's discretion whether to distribute the profits that they make in a year in the form of dividends to the shareholders. Okay. Dividends is nothing but a portion of the profit that gets distributed among the shareholders. Now, if the company hasn't distributed any profits in the previous years to the shareholders, then that money is considered as retained earnings. You may think why the company did not pay it to its shareholders. First of all, it is at the discretion of the company whether to give out dividends or not. And secondly, it could be because company may think that they need the profits that they've earned to reinvest back into the company on behalf of shareholders, and it will further help the company to grow. Okay. So that is the reason sometimes companies do not pay out dividends even if they are making profits. You may ask, what about the earnings they make this year? It is called net profit. It is sometimes also referred as net income. Net profit is the profit that is made in the current year. Okay. And net profit is considered as an equity. And equity belongs to whom? To the shareholders. If a company is making profits, if company is earning more money, then that money and the profits belongs to the shareholders. But whether to release the money to the shareholders or not is something that is in company's discretion. No shareholder can go and command that you have to release the dividends. It is in the company's best interest, companies would work. But you may ask, how come then the shareholder gets benefited? The shareholder gets benefited because the amount of share that he holds in the company is now gone up because the profits were not released in the form of dividends. The profit is getting accumulated as an equity. Now the equity portion is getting bigger and we have the same number of shareholders. The shareholder will get a bigger portion than what he or she has invested in the company. That is the benefit for the shareholder because he or she knows at the end of the day that even though not received dividends, the share value of the company has gone up, and as such, they should be happy with that. Now let us understand incomes and expenses and their types.